Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, June 10th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. This is for informational purposes only. I am not a financial advisor. I cannot give financial advice to individuals. Please do your own due diligence. It's your money. It's your responsibility. I'll say, okay, so quickly, housekeeping note. I mean, we used to post the weekly market update to a podcast tool called Anchor Podcast. And what I liked about Anchor is I could just take the video file that I'm making when I make the YouTube video, and I could just upload it to Anchor, and it would convert it automatically into the requisite file needed for podcasts, and then it would automatically distribute the podcast to various podcast platforms. So it was like a couple clicks, 5 minutes, it was done. And then Spotify, I guess, bought Anchor or took it over. And ever since they have, the thing's been jacked up. It works half the time. I'll upload stuff. It doesn't work. I have to go back and upload it. Sometimes the site freezes up. I don't know what's going on. So that's one of the reasons I've had people reach out to me, because we had a pretty good audience on just the podcast form. It was convenient for people when they were driving to work. I know that, or walking their dog or what have you. And so I want to, continue that. So I do see that YouTube does have a podcast function now. I'm going to try that with this week's. I'll play around with it. Look in the show notes for this video. I'll try to link to it, or however. I haven't really even done anything with it. But I don't really want to get into paying for a, podcast thing. I kind of did it as a convenience for people. The main focus is the videos. I mean, a lot of work already goes into the weekly video, and I don't want to spend like an hour, 2 hours trying to upload a podcast every week. So that's what's happening with that. So if you were a fan of that, or you were using that, that's why it's kind of been hit and miss and kind of went away. I'm going to try to fix it, but just be a little bit patient in the interim. And we'll try to find some way, because I'm trying to find something that is usable for you guys, but actually easy for me also, because like I said, I'm just a one-man band here. Okay, let's get into this week's report. So this is I thought this was great, for this week to start the slideshow. Why? This is the cover of Barron's. It says, "This market has legs." As you probably know or have seen, we're in this kind of rally in the stock market right now, which, if you look at the underlying metrics, basically is being pushed by, 8 or 10 of the large cap tech stocks. As you know, the indexes, like the S&P, for example, they are market weighted indexes. And so the larger your market cap, the more influence you have on the index. And obviously, with this, whether you want to say it's because of AI or whatever, I don't really know. This is not sustainable. You cannot have, just a few stocks pushing the market higher. And especially with the fact that I think that the indicators that we're following, we are heading for a recession, and I think a really bad recession. Okay. I think that we have reached the Wiley Coyote moment. If you remember the Roadrunner cartoons, the inept coyote would be chasing the Roadrunner around with his different schemes. And then at least once a episode, Roadrunner would stop, Coyote would continue, he'd go off a cliff, his legs would be, going back and forth like he was running, and then he would look in the camera with the realization that he was, going to fall, and then he would fall. That's kind of where we're at now, I think. I think there's been a lot of narrative setting by Wall Street and by a lot of analysts. We kind of moved from, having the biggest rate increase, the quickest rate increase in the last 40 years, We've talked about it before. We've talked about the lag effect of QT and this rate raising cycle slowly but surely making their way through the economy, and that's happening now. And I think that, a lot of people misunderstood, and, it's not like it's some big revelation to me. Like I figured this out on my Rinky Dink podcast or video series, and everybody else, didn't catch it. There's been quite a few people that have said the same thing. So, but the majority of people, the market action is higher, summer rally. I think when this thing exhausts itself and eventually, reality is going to set in. Uh, One of the tools that I use, I've talked about it in the last couple of weeks, is my nowcasting, my kind of reverse engineering the hope cycle work, and it's been really positive. Why? Because again, I'm not trying to forecast what the economy is going to do, okay, with this tool, but it's telling me what's going on and showing me these inflection points. Like we just saw an uptick in first-time claims for unemployment insurance last week, okay? And that's what I'm starting to pick up is stuff like that. Instead of just having an overall general opinion, anecdotal, I'm looking at these facts, I'm looking at the data, and it's I'm assigning, green to positive trend, neutral if it's a kind of neutral, or red to a negative trend, and the majority of the trends are negative. So that doesn't necessarily mean that, that correlates directly into stock market performance, but in the past, when we have a weak economy, we typically have a weaker stock market. This stock market is still tremendously overvalued. It's being pushed higher by just a few stocks. There's a lot of hope and copium going on. And I think that once the data becomes undeniable, then we're going to see a sell-off. I think and I think that a sell-off of 25 or 30% into, by this, this year, later on this year in the second half, that would be sufficient to scare the Fed. We're looking for a financial, something to happen financially in the banking sector or economy-wise to get Fed to reverse its liquidity cycle. I track global liquidity. We still have the majority of central banks raising rates around the world. I think the last time I looked at it was yesterday. And we've had like over 100 rate increases by different world central banks this year, and only 22 or something like that rate cuts. I will note that we've seen rate cuts in countries like Sri Lanka, Georgia, Vietnam. So some of the emerging frontier markets like Georgia, for example, I have a way to play that in the newsletter, Actionable Intelligence Alert newsletter. The Georgian economy is growing by 7%. Inflation is down. The currency is appreciating against like the British pound, for example, in the US dollar. They have a lot of capital inflows. So there are pockets around the world. So as inflation goes down in these areas and manifests itself in deflation or disinflation, some central banks now are starting to cut rates. And again, I said, I think that the whole liquidity thing has really turned. Why? Yes, we still have QT happening, but do I really see, with the pause that we're talking about that, we're doing in the US, I think the economic news and the data that's going to come through is going to be sufficient to preclude further rate cuts. But again, I'm just a guy on the internet. This kind of stuff here, though, I don't want to say that magazine covers are 100% because they're not, but they do give you some insight into some contrarian thinking. And when you see stuff like this, after we've had this big move in the market with only 7 or 8 stocks, what's that telling you? Okay. Do you really think with the economics, anecdotes, and data I'm getting ready to show you that that's going to be positive for sentiment going forward in the context of continuing tightening liquidity? I don't think so, but we'll see. So this is part of the anecdotal stuff that I, pick up on that I get I kind of look at myself as like a data gathering person. I realized something when I was listening to somebody talk on a podcast about like really how the CIA works, or these national security agency, or any of these intelligence agencies around the world. They're just massive data gathering, and that's what I do. I just take in a lot of data. I parse through it. I tried not to just pick out the stuff that's biased towards my, thesis, because that's not good to do. That can get you in trouble. But that's what we do. And this is an example. I follow this guy on Twitter, car dealership guy. He's anonymous, but he's runs or owns like several car dealerships. He knows what's going on in the market. He was on a couple podcasts. And, this is the kind of anecdotal things that tell you that this isn't what happens. This is what happens in a credit crunch. This is what happens when liquidity tightens. This is what happens when free money goes away. And so what are we talking about? It says here in his tweet, the past 60 days have been a roller coaster. Capital One shut off all dealer floor plans, aka inventory lines of credit. That's floor plan credit is, the dealership doesn't just get cars for free from the manufacturer. They have to finance those. They buy them from the manufacturer, and they use financing to do that. That's what floor plan credit is. And so you have Capital One shutting off all dealer floor plan. That's pretty significant because Capital One's pretty big. Now, that's not just a one-off. It says U.S. auto sales shut down 39 dealerships. Wells Fargo laid off all its junior auto loan underwriters and capped future loans. Penn Fed Credit Union started cutting dealers from indirect auto lending. Citizens Financial Group exited indirect auto lending space. So this is anecdotal. I don't have a chart to show you, but if you've been following this guy, you'll note, and listening to him, you'll note that credit is tightening and things are going to get worse for dealerships and consumers. Because why? The banks are tightening lending, not just in card for auto loans, but across the board. That's not positive for the economy or sentiment. So this was CFO magazine or CFO.com. It said 77% of companies are currently undertaking or considering layoffs. It said much of the survey was dedicated to issues around layoffs. A key finding was that many workforces are shrinking. More than 3/4 of participating HR leaders said their organizations are currently undertaking or considering layoffs. Additionally, 56% of surveyed workers said their team, unit, or division had been downsized via layoffs in the last 12 months, the report points out. So again, not positive. We've heard this thing about shortage of workers. Yes, if you look at the employment data and what was being touted, the data is not showing like employment growth or jobs being created in like manufacturing or things like that. A lot of it was in service type stuff, restaurants, things like that. And I think there's a lot of seasonal workers. I think we're in the last hurrah, the last blow off this summer vacation season. People are out there spending, they're traveling, they're having their experiences because we're already in a recession in the housing market and in manufacturing. And like I saw last week, ISM service PMI is now declining. It's right barely above like 50.6, I think, is the reading that came in. We're just slightly above dropping into contraction in the ISM services report. So all the data is skewing towards that, the economy is rapidly weakening. All the data is starting to come in. So I thought this was a great article. This is I do follow certain people. A lot of smart people write quarterly reports, monthly reports, people that run money. One of the people I like to follow is this outfit called Palm Valley Capital. I'll put a link to the article that they posted or the paper they wrote. I thought it was really great for a couple of reasons. The guy was talking about when he was younger. I think when he got out of high school, he worked, or on summers, he worked at a garage back in like the early 80s. He was talking about, the stuff that goes on in there, how things work. And the thing that amazed him was how people would skimp on, required maintenance. They would bring a car in, people would tell them, hey man, you need a brake job, your brakes fail. And they said, well, just put the tires back on. I'll just drive it for another 5,000 miles. So one lesson to take out of this is, which I've learned in my life, and I am very, very adamant about, especially with how much it costs to buy a vehicle now. I mean, you really should maintain it properly, and you should follow the OEM recommendations. And that means, sometimes you have to change plugs, you've got to do your oil changes, you've got to do inspections, run some fuel injector cleaner through there occasionally. These things that you should be doing, look at your tires for wear. And a lot of people don't do these things, and they just run the car until it breaks, and then they're stuck with this big bill. Entropy eventually overtakes any vehicle, or any mechanical device eventually wears out, but you can extend and get the maximum value out of these things that you're paying money for by doing the proper maintenance. And that's one of the things that I think I took away from that. But that's not the main point of this. The main point of it is that across the board, and he cites many, many examples, companies recently reporting about how the consumer is getting, especially in the middle class of the middle of the middle class and lower middle class and lower classes, working poor, whatever, they're getting just completely eaten up by inflation. Now, inflation is coming down, but the point is the price rises that have already taken place, they don't get rolled back. So even if you go back to zero inflation, okay, you still have embedded now, 20% or whatever higher, I mean, I was in the grocery store the other day. I like to, occasionally, buy different things. I'm just shocked at walking around the aisles looking at some of the prices, like, for a bag of chips, it's like $6, for, a bag of Lay's, and you shouldn't be eating that stuff anyways, I know, but that's a lot of money, and a 5-pack of ribeyes, $80 or whatever, $90, whatever it was. And they weren't thin cut. They weren't super thick either. So I can afford to buy stuff that I want to buy. I'm fortunate, but how do you get by if you're making $38,000 a year and you got 2 or 3 kids? I mean, I can't imagine these prices. And like I said, that's going to have an effect on consumer spending, and it is. And this is one of the things they talk about. So here's a couple snippets from the article. It says, and to reiterate what we've been documenting for several months, the inflation rate appears less important to the consumer than the inflation that has accumulated to date. In our opinion, the rate of inflation could drop to 0 tomorrow, and the stress associated with past inflation would remain. In effect, it's the significant amount of purchasing power that has been lost over the past 2 years that is driving consumer decision-making, not the monthly fluctuations in the rate of inflation that amount to fractions of a percent. With accumulated inflation showing no signs of reversing, consumers are fatigued and running out of options to sustain their standard of living. We believe the slowdown many consumer companies experienced in April and May, and they do document, as this notes in this article, many examples, is a new and important development. Have we finally reached a point of spending exhaustion where the decline in the middle and lower income consumer outweighs the growth in spending from the higher end? From our bottom-up perspective, it appears a growing number of consumers have reached a tipping point. Yeah, we're at the Wiley Coyote moment. There's one analyst I respect, and he's like, I don't see the recession. I see, but where he's looking at, top end wealthy people are not going to experience recession. Upper middle class people, it's not going to affect them as bad. Okay. And so if you're focusing on those areas, you're not going to see it like if you focus on the majority of people. Okay. And this is why this is kind of what I've been looking for. I didn't even consider, this, as they said here, this the effect of it's the amount of purchasing power that's been lost over the past 2 years that is driving this inflation that we've already accumulated as everybody jacked up prices. They're not going to roll those back. It's going to and especially in the context of the fact that we have many now secular points that are going to push inflation higher. Rolling back of globalization, nationalization of resources. I mean, all these things that, the demographic issues in China, the low-cost manufacturing being dissipated now, as that gets discombobulated because of demographics. All these things that were, again, tailwinds for lower inflation or disinflation over the last 20 years are now reversing. And so you're going to have, and now, I would get into it further that, we're probably going to need some point of running at at a low grade fever for a while vis-a-vis inflation, just to maintain our fiscal and debt situation here in the United States, to try to inflate the debt away. So there's going to be tremendous pressure on the population, and they're going to feel it. And that's going to, by the tens of millions and hundreds of millions of people in this country, it's going to affect consumer decisions. So here's a tweet by Carl Quintanilla, CMBS. Bank of America, watch the quiet credit crunch. 30 large companies defaulted in the past 5 months, 11 in the past 4 weeks. Just as unemployment claims turning higher. Interrupts new, quote, no recession 23 narrative. We're in a recession already. Okay, the data is showing that. Now with the latest ISM services, it's in decline. Yes, it's still barely above 50, so it's expansion, but the trend is down. I suspect by next month or the month after, you're going to be below 50. You're already well below 50 in manufacturing. So housing, manufacturing, and now services is below, in recession or in retrenchment. How can you not say we're not in a recession? Then the question becomes then, once the acknowledgement of the recession is here, how now it's going to go from, is it a soft or hard landing? And the data that we're looking at, we have a tremendous amount of bank credit and credit crunch is happening, guys. Okay, that liquidity overall feeds into liquidity. That's just going away. It's like a puddle in 100-degree weather. It's just evaporating. And without that, with money supply growth being negative, I mean, I can just, this is not looking good. And this is why, I kind of agree with what Felix Zulauf said. Once the Wiley Coyote moment happens and on the central banks realize, they're going to reverse course very quickly. That's why I say I don't agree with some folks. I mean, they're going to panic, because I think you're going to see the stock market down, like I said, 25 or 30% between now and the end of the year. It's quite possible. And that's going to spook them. The numbers that when the unemployment rate starts marching higher, which I believe it's going to, it's we had continuing, or the initial claims start to rise last week. It's a one-off. We'll see. We'll have to see. But that was like the last bastion. That was the last line of defense. Everybody's saying, well, all these other indicators that people are bringing up, yes, you're right. They're softening, they're getting weaker, but employment's hanging in there. And as long as employment hangs in there, the consumer will spend. Well, I think that again is turning now. So here's something we showed the other week. Here's cardboard box demand. Hasn't been this weak since the great financial crisis. Again, we talked about this before in previous weeks. Here's the great financial crisis when cardboard box shipments were down. Look where we're at now, guys. Okay, this is the weakest we've seen since the great financial crisis. And it doesn't I can't see if it's turning here. Maybe it's bottomed. I don't know. We'll have to watch it. But again, these are anecdotal, but is this an indication of, positive, economic data? I mean, I don't think so. And when you see, I start getting nervous when we have like this Barron's cover talking about the stock market's going to keep going higher in the context of economic data and anecdotal data coming in that is as bad as the 2008 GFC. So I don't think it matches. Something is not right. Either the economy is the market. And the thing to remember is, you might recall I put a chart up about maybe a month ago. I think a lot of folks are saying, okay, well, it looks like you're right. The data is getting weaker. And so that means the Fed's probably going to stop raising rates. And if they do that, that's positive for stocks, because that means eventually they're going to cut rates. but that's not typically what happens. What happens is when the Fed, you don't see a bottom in the market until well into after the Fed starts cutting rates. So you will be well into the rate cycle or rate cutting cycle before stocks bottom. And right now they're making, they're being, we have Barron's covers telling us that we're in a new bull market. So right at the top, basically. I'm looking at a company like Apple. I'm not a tech guy. I have an iPhone. I play around, but I'm not like a coder. I don't know the newest tech things. I'm not in that. But when I see so Apple's sale revenues and stuff like that are stagnating. This is an example. And now the new product is a what $3,500 VR goggles that you're gonna be walking down the street with this on your face. And I mean, is this who's buying this? The consumer that is getting dogged out at and buying chicken wings and refried and pinto beans to live is buying a $3,500 VR headset, and that's going to sustain the market cap and provide the next leg of revenue growth for Apple. I don't know. It could happen, I guess. I don't think it will. So again, in deference to I have a few German friends and subscribers that have been very with me for a long time. I don't like picking on Germany. Again, I admire Germany quite a bit. I admire the engineering and manufacturing prowess, the ability to do what it did, be the bastion of growth and stability in Europe post World War II. But this is just bad policy. This is what happens with bad policy. Now, obviously, they're in a recession, but people don't understand. Like a company like BASF, the largest chemical manufacturer in the world, has huge operations in Germany. Notwithstanding the fact all over the world, they have them right here in Houston and South Texas. Here they have quite big operations also. But you can see again, this is the great financial crisis pullback in German chemical production. Look where we're at. And this is just, most of this is a self-inflicted gunshot wound. Now, you can say to yourself, the argument is made to me, well, we had to cut ourselves off from Russian gas. It was a moral imperative. That's fine, but this is what happens. And the thing that bothers me about this is that there is a large group of people in Germany that want the country to deindustrialize, that don't want to produce chemicals in Germany, that want these industries to go away. And so I think now what you're seeing now is though some pushback. People are realizing, with the big discussion around the boilers and the heat pumps and all the, green stuff, the greens now, again, these politicos, these politicians, these globalists, these people with this agenda, they never have a referendum. Why not go to the people and say, okay, because of the war in Ukraine, we've, cut ourselves off from cheap Russian gas, which basically supplied, the energy inputs and feedstock inputs to this tremendous economic miracle we have here, an engine of growth, the golden goose, if you will. Let's have a referendum. We have but we have to balance that against our environmental commitment and who we are as a people. Do we want to deindustrialize? This is our opportunity to do it. Do we want to do it? But they don't do that. They just implement this stuff willy-nilly and try to jam it in or sneak it in. And, and here's what you got, okay? And again, these manufacturers have already starting to talk about moving their manufacturing out of the country. And once the manufacturing moves out of the country, it doesn't come back. It doesn't come back. And so standards of living go down. And I would challenge people in Germany there's plenty of websites. I think there's a guy, Nick Johnson's his name, I think. I don't know. I'll find it and put a link in the show notes. He drives around to all these places in America that you never hear about. Okay, these towns that are dying. You can see what it looks like when you see a deindustrialization, when you see jobs go away. You will have poverty, rot, social dysfunction, pathology, social pathologies, you know, all kinds of wacko stuff goes along with it. So, you know, I think people should actually have referendums and have both sides put forward to them so they can decide if that's what they want. Okay, because people just seem to forget and take for granted everything that they have. And then once it's gone, once it's shipped to India or Vietnam or wherever they're going to move the stuff to, or the US even, it's not going to come back. So this is really like shocking. This is like a plane that the wings fell off and you're plunging to earth. I don't see a bottom here. This is what's even more disturbing. So I don't know. I don't feel really good about it. I don't know how most German people feel about it, but it seems to be that the political winds are starting to shift in Germany. Hopefully, before it's too late. So I call this a sort of Damocles. One of the things, this is a chart that shows spending as a percent of GDP. You can see this basically it blew up during the pandemic, obviously. Here's the revenues as a percent of GDP. You have a situation developing here where you have a 8.1% gap. You have revenues as a percent of GDP going down. You have spending going up. And this is going to continue as long as rates stay high. Why? One of the reasons is that notwithstanding the fact that you have this inexorable and ongoing growth in entitlement spending, which isn't going to go away for, a decade or more due to all the old people that are retiring and going on Social Security and Medicare. But with rates where they are now, I've talked about this before, as you roll the debt of the US, you have to refinance it at higher rates. And so that's why, interest on the debt is approaching $1 trillion a year. It's just below, it's like $980 billion a year right now. And every week that goes by, that's what, with rates staying up here, this number is going to go higher. Now, that doesn't mean it's actionable or we're going to have a default or something like that. What I'm trying to get through to people is you have to have, your what's actionable, what can you do, but what's the long-term trends? You have two political parties that are diametrically opposed to each other. You have nothing that the things that need to be done to solve this problem, okay, with the debt and the entitlements and all these things that are eventually going to rip this country apart because you cannot continue to spend money and go into this type of debt. The federal government itself, after this budget deal, has already said by 2032, you're going to have $50 trillion. You have 31 trillion. You're going to have $50 trillion in debt in the United States. And there'll probably be more because when you go into these recessions, guys, automatic spending goes into place for unemployment insurance and all this relief that has to be paid, automatic stabilizers that isn't being paid for. And so they just issue more debt. And so with rates being as high as they are, with the debt continuously increasing, I mean, I think the week after the so-called budget or the debt ceiling limit, I mean, the debt is up $400 billion in a week. And so is it going to do anything this week or next week or a year? Probably not. But it's like a cancer growing. And so eventually you're going to have a crisis. And the point I'm trying to make is think about that. Think about other countries that have fiscal and government debt crises and what it means to live in that country and to have your business in that country, your job in that country, your bank account in that country, and all of your investments in that country. Because what you have seen throughout history is what will they do? What will be the initial reaction to deal with these problems? A lot of inflation, higher taxes, money creation, clamping down, okay, currency controls, bank holidays. I'm not saying pick up and run out of the country. Okay, the U.S. is still, right now, a fairly, open country, but you can see over time what's going to happen. There's nothing. The political climate in this country is not going to allow itself to solve these problems. You're going to have to run directly into a crisis, and the wheels are going to have to fall completely off. And that means a lot of pain and suffering. Now, is that going to happen this year, 3 years, 5 years, 10 years? I don't know. But the federal government itself says that the debt's going to be $50 trillion, in 10 years. And I think it'll probably get there quicker. Okay. That's another reason why these rates aren't going to be staying high for very much longer. Can't afford it. Okay. Because you're just borrowing money to pay the interest on the debt. This is like akin to the crazy person that is, taking cash advances on one credit card to pay off the minimum payments on another credit card. That ends in bankruptcy at the individual level, and businesses that do it, it ends up in bankruptcy. And we know throughout history, the same thing happens to countries. Okay. This is why I think, the entire OECD is in the same boat. And that's why I talk about diversifying yourself, looking around the world for other opportunities, taking advantage of them, having some position in physical gold and silver. There's opportunities for real estate in other countries. Now, again, if you have $5,000 to your name, it's not worth it. But if you have some wealth, I don't see how you can just sit here, because you can see what they're going to do. The historical narrative is clear. Okay. They're going to do stuff around the edges. They're going to use inflation and money printing to cover it up. And eventually the wheels fly off. Okay. Again, it goes back to not repairing a car. If you don't ever change the tires, if you never change the oil, if you beat the hell out of the car, eventually you're going to be driving, all think, something's going to happen, and it's going to break down on you. And that's what's going to happen here. And this is just not sustainable. And so I think if you have some wealth, you need to think about that. You can't have everything. That goes for any country you're in, especially in Europe, which is even further down the road. You can't have all of your assets, your whole life, in one currency, locked up in one economic bailiwick. You're just putting yourself at tremendous risk, and your family and your wealth at risk. So there are opportunities. I'm not the expert on it. There's different things that people can do based on the wealth that they have, their temperament, their ability to how much risk they want to take. But those windows will begin to close as it becomes obvious what's going to happen. And I see what I see in the leadership in this country, both parties have no leadership. There's no interest in solving these problems. All there is an interest is to get your hands on the levers of power and steal as much money as you can for themselves and their constituents and their backers, financial backers. That's it. And so that may seem cynical. And so you need to understand what's going to happen. If you're in your 50s and you have, no savings, you're going to have a big problem here, because whether you like it or not, your benefits, if you're going to rely on Social Security as your only income, you're going to be finding out that inflation, they'll pay it. Alan Greenspan said that to Ron Paul during congressional hearings. We'll pay it because we have a printing press. I don't guarantee the value of those dollars, though. I mean, this is getting serious, and your time to make adjustments and prepare yourself is running out of time. Now, I don't mean to be a doomer. I'm not a doomer. I'm very positive. Long term, there's many places around the world that are have tremendous opportunity, and you can take advantage of them right from your living room in the US currently. And there's even more opportunity if you get on a plane and go somewhere and are able to make some moves. So that's my view. I call it the sword of Damocles. You're sitting on the throne there. You're sitting in the US on top of the world. America, love it or leave it, and you have this sword hanging above you with a horse's hair, and things are not going in the right direction. Again, you can look at, I just don't see what other people are seeing, and maybe it's just different perceptions and biases. A lot of people say, man, you really, people like you don't like. It's not that I don't like. I love the United States. I love the concept of freedom and liberty and things of this. What I don't like is what I'm seeing now. And this is not sustainable. And this will lead to tyranny. This will lead to losses of liberty. This will lead to losses of property. Okay. And there's nobody advancing any, on either side, advancing any agenda to get this under control. So if you go to 50 trillion, so if you're in your 20s, say you're 23 or 24 listening to this, and in 10 years you'll be 34, and the federal debt is $50 trillion, and then while you're 44, it's 100 trillion. Do you think that that's just sustainable, doubling the national debt every decade? The economy's not doubling in size. You can't pay. So anyway, it's something to think about. I harp on this occasionally. You don't have to panic. You don't have to run out and do something today, but this needs to be on people's radar screen. But this is another reason why I think that, rates are not going to stay higher for longer, because the interest burden, like I said, is getting ready to crack $1 trillion. So if you're invested in tankers like I am, clean tankers and what they call dirty tankers, oil tankers, I'm very positive on them because why? They're in the same situation that many other uh, many other real assets are in. Lack of investment, and rust is your friend when you talk about real investments. Rust attacks ships, steel, drilling rigs, offshore service vessels, what have you, plant and equipment. Entropy is your friend, I guess is a better way to say it. Because if you're not continuously, making investments to replace, these investments are a very high capital cost, for a tanker, $100 million or more. And then it has a lifespan of 25 years. Okay. And then it's depreciating because, it's going to wear out and it can't just run forever. And entropy and rust takes it over. And so we haven't been investing because, quite frankly, tankers have been a horrible business. But that kind of changed recently as the lack of replacement because of the overinvestment from the previous cycle now has worn off. There hasn't been new investment to replace the older tankers. You've had some other things affecting the market, like the ambiguity around regulations for climate change and propulsion systems. So people don't want to make big investments into a tanker and then put the wrong engine in the darn thing and be stuck with an asset that they can't use. The other thing being the discombobulation in the global trading, fuel trading and transportation network because of the sanctions against Russia due to the Ukraine war. We've talked about that. And the fact now that, yes, even though tankers now are starting to be ordered, you can't get a slot in a shipyard. You can't get delivery until 2026. So you have a window of opportunity for these investments, for these companies to generate above average cash flows and returns to shareholders simply by virtue of the fact that they have a lot of factors coming together that are providing tailwinds. And so here's one of them. This is from the TK Tankers recent discussions. It says TK Tankers predicts that the tight supply-demand balance in the mid-sized tanker market will persist, given that the tanker order book stands at 4 to 5% of the operational fleet, near historic lows, which we've pointed this out before. Although new orders have begun to rise, this year's orders are anticipated to total only 24 million deadweight tons, below the historical annual average of 30 million and far below prior super cycles when day rates were high. The earliest delivery of new vessels remains in 2026. And the reason why is because all the yards are filled with orders for container ships and LNG ships right now. And so you can't get a slot. So that's your window of opportunity. And again, we're in a low spot seasonally for tanker rates, and they're still way above what they have been in the past. And so I feel pretty good about it. We have some holdings there. Some of the money has already been made pretty decent money so far, seeing really good high dividend rates and share buybacks now as the cash flows start to come in. So I don't think a lot of these companies are going to be in a big hurry to build out their fleets. That's one thing I am watching, because once they do that and start going out and building way above replacement cost, because if they think we're in a super cycle, that's what will kill the recovery. It's the same supply and demand dynamic of any commodity business. If you have overinvestment, it creates excess supply, which drives down prices and creates a bear market. Talked about this before. Again, offshore service vessels. Here's a snippet. I like, this is another guy I follow on Twitter. Man, if you're not cultivating and curating a Twitter, I have all these people that I follow on Twitter that are specialists in certain things. It's just tremendous the amount of knowledge you can get. You can I even interact with some of these people, ask questions. I mean, you're really getting, I don't know why these people do it. I mean, they have very small followings, but they're experts. They get you a lot of this information, and it's tremendous. If you're not doing that, you're missing out, because being a generalist investor / speculator, I can't deep dive. As I'm like I said, if you're a one-man band, you can't be an expert in every single field. Well, what you can do is find people that are experts that have demonstrated that they're not fly by night or a goofball, that they actually know what they're talking about. And then you can start to get some insight into things and get that information advantage. Okay, that gives you the ability then to deploy capital in a place where everybody else is ignoring. So what do we say here? It says this is kind of amusing what this guy says here. It says, for the 3 people, I guess I'm one of them, 3 people reading this who care about offshore vessels. This is from Fernley's, which is a company that tracks shipping news. It says, from the PSV players, those are the your offshore vessels, service vessels. The market in Norway is still tight as a drum, with no vessels available until next week at earliest. Recently, we saw another medium-term contract handed out by a Norwegian oil major. Term contracts are handed out in the UK as well at increasingly healthy rate levels. The last spot fixtures in the UK are done at around £25,000 per day, with less than a handful of prompt available vessels. This is what you want to hear. This is the kind of news that you want to hear when you're in a bull market. I can tell you that's very high. The rates have been increasing dramatically in the offshore service vessel all around the world, okay? Quite frankly, there was I've said this before, tremendous depression in offshore services to begin with, especially in offshore service vessels. Again, entropy is your friend. A lot of the vessels were cold stacked, which means they were even taken out of the water, or they were wet stacked. No maintenance was done. So a lot of the fleet overcapacity of older vessels that was hanging over the market, that's never going to come back to market. Why? Every couple few years, you have to do a inspection on your vessel. You have to bring it in, and the older it gets, the more expensive it gets to do the inspections and get the thing re-registered so that you can operate the vessel. And so when the inspector comes on board, a port engineer or whoever's doing the inspection, and looks at it and says, okay, here's the checklist. You got to do this, this, and this before you can get the thing re-registered. At some point, it's not worth doing, right? Again, and so a lot of vessels were taken out of the water because of the oversupply, or they were just piled up in ports or whatever, and they deteriorated, and the amount of money necessary to reactivate them is not, going to work. And if you listen to one of the premier offshore service provider, which I'm not going to name the name, you should be able to figure it out, but it's in the portfolio and has done very well for us. I mean, they already said that they're seeing tremendous rate increases in all their markets. But, when they were on this particular podcast, the podcast host asked them, well, in the previous cycles, that's meant that you guys have went out and built all these boats. And they said, no, we're way below the level, even though we're enjoying above market and historical higher rates, we're well below the level needed to incentivize us to go out and build more boats. Okay, we can't pencil the numbers to work. And if we did at these levels, again, it would be hard to get somebody to build it. Would we be able to justify the cost over the life of the vessel? And so right now you're enjoying, again, a window of super normal, above normal profits. and cash flows. Okay, so if that cash isn't going to go into new vessels, it's going to go back into share buybacks and dividends. So this is your opportunity. Again, it's a supply and demand situation. If you don't have, you just need, this is what I predicted would happen a couple of years ago, that because of the depression, because it was so bad in the offshore sector, it was so decimated, okay, and so many people and so much equipment went away that we didn't need a return to previous cycle highs for this to be a tremendous opportunity. We just needed a slight uptick in activity, and because we don't have the supply of vessels and rigs and all these things, you were going to see rates go way high. And again, do you have $1 billion to build? You can't get a modern drill ship right now. Okay, that's why rates are moving higher. All you have to do is go look at all of the offshore service providers, their quarterly reports or their presentations. You can see what's happening. And when you listen to the managements, I heard one of the managements say this. It used to be you could go and say, okay, I want to order a drill ship, and you could talk to a Korean or Chinese yard, and you only had to come up with a certain down payment, and there was milestone payments. But they won't even do it now because they got burned. They got in situations, these yards where these operators ran into hard economic times or a downturn that we saw in the industry. Their cash flows dried up. They couldn't make the milestone payments. So you got this vessel sitting in a dry dock being built, half built or not even half built, sitting there with no money coming in, and the thing's sitting there. Okay. And what are we supposed to do now? So, several of these folks have said that if you want to build a new vessel, you're going to have to come with a big chunk of change. And again, there's no yard space to build a vessel. So again, we're into the situation where it's not necessarily about demand this cycle. Okay. People focus on demand. We're going into recession. The demand's going to get killed. Yes, prices will weaken cyclically during this recession that we're getting ready to have, but the monetary response will reverse the liquidity. It will go into a liquidity upcycle. And because the supply is so constrained, I just don't see things drop back a little bit across the board in resources and commodities and these commodity type industries. Possibly, yes, but I don't think you're going to see the bottom drop out. And I think that's going to surprise people. And then when we get into the next reliquefaction cycle of central banks reliquefying the system, these things are going to scream higher over the rest, next several years. I think you just got to be patient and just, understand really what's happening. So again, there's always bright spots. Everything's not negative everywhere in the world. So here's a report. India's fuel demand jumps to record high. The Indian economy is probably one of the higher growth economies. Country of Georgia, which I'm high on, has like 7% growth. India's like 6.5, something like that. There's pockets of what do you call it? Strength. And there's ways to take advantage of this. I have a company in the Actionable Intelligence Alert newsletter that sells at about a 30% discount to net asset value. That means you're getting $1 for 70 cents. And the primary asset of this holding is a majority ownership of the third largest airport complex in India. This particular airport complex just did a huge renovation and expansion. It has additional acreage around it for expansion, and it's based in one of the main cities in India where the high-tech industry is based. And so, again, you can buy it for 70 cents on the dollar. And the company that I'm talking about understands this. It's run by one of the wealthiest people in Canada, a value investor in the similar vein of Buffett. And so there's always opportunity. But let's get back to the fuel demand. Says India's fuel demand jumps to record high. Fuel sales in India rose by 9% year over year in May, setting a new record high for the country. Sales of diesel in India jumped by 13% year over year, while sales of gasoline surged by 11%. India is one of the few bright spots for oil demand at the moment, with concerns about economic growth elsewhere weighing on oil prices. India's fuel sales surged in May from a year earlier and from April to new highs, suggesting that oil demand in the world's third largest crude importer is strengthening and could outperform expectations. Yes, that's what's happening. This is why, when you see like diesel is the lifeblood of an economy, it's up 13% in India. Now, is India large enough of a fuel importer to offset the weakness in other places? No. But again, are we closer to the beginning of the rate cutting cycle or the rate raising cycle or to the end? We're closer to the end. And so, again, as it becomes obvious, we're in recession in Europe. China's struggling now. The US is in recession. You're going to see the monetary response. We're waiting for it. And then I think, you'll see the next, again, liquefying cycle, and sentiment will turn and economies will come back, and we haven't made the investments. I said it recently on another podcast. Somebody interviewed me and I said, is it possible we could see 50 before 150? Absolutely. I mean, I don't know what's going to happen. It's kind of confusing and hard to see what's going on in the oil market right now. I mean, demand and supply are, the idea was the China reopening didn't really happen like I thought. It did reopen. Fuel demand did increase, but wasn't sufficient to really overcome what we saw with Iran dumping a bunch of fuel, Russia. Now we've seen OPEC do these cuts. So we have to, a lot of plates in the air. But again, I feel good about it because we're going to go through this cyclical period over the next 6 months to a year where economies are going to be weak. You know what the response is going to be. Ask yourself, if the economy gets weak and we go in recession, what do central banks do? They cut rates and they print money. That's what they do. What happens when they do that? The things that you can't print, like hard assets, they're going to go up. That's it. So, and then you do actually have economies like India's and other places that are actually growing in real life. So, again, I think that we're going to have record highs in commodities over this decade. We just need to get through this period of cyclical weakness. But this is positive news. If you're in India and the economy is expanding at 6.5% and you have this demand, well, it's good because it's such a fuel importer. This is beneficial to the Indian economy. Okay. And you want to see cheaper oil prices for oil importers. So I wanted to bring this up. This is kind of a two-part, kind of amusing for me, and it's also indicative of what you see in junior mining. Okay, this is like the best, one of the best examples of the horse crap that goes on in junior mining companies and what goes on up in Canada with these companies. Okay, and why you have to be careful. Okay, and that's why you can't get visions of sugar plums. This is what the majority of these companies are like. Okay, the majority, and so people whine and cry about the junior crapco they bought that isn't going up. Well, they're not as bad as this situation, but this is what I'm talking about by lifestyle companies. What I'm talking about is glomming on to a narrative. Okay, so this is the news release. Friday's Dog Holdings Inc., that's the name of the company, to be renamed International Uranium Corp., is pleased to announce that management of the company, this is the management of the dog shampoo company. This is what this company does, makes dog shampoo. They're pleased to announce that management of the company, they decided this now, after review and consultation with its advisors, what advisors we don't know, has determined it is in the best interest of shareholders of the company to complete a business combination transaction with a wholly owned subsidiary of American Lithium Corp., another company I never heard of, that's on the TSX Venture Exchange. The transaction will be completed by way of a court-approved plan of arrangement under the Business Corporations Act, pursuant to which the company will acquire all of the outstanding securities of Macusani Uranium SAC, a wholly owned Peruvian subsidiary of American Lithium, incorporated on October 13th, 2022, and change the business of the company to uranium exploration and development as further outlined below. At the same time, the company will spin out its existing business to existing shareholders. So this is what you have to be careful of. Now, I find it amusing in one respect, but it's indicative of something else. The uranium story, the bull market, I think we've reached an inflection point. I think we're going to be heading to that third, we're heading and setting ourselves up for the blow off top. This is the kind of nonsense you start to see. At the top of the market, this will be every week, something like this. Remember, at the top of the last uranium cycle, there were over 500 companies in Canada that were supposedly in the uranium development, exploration and development business. Let me ask you a question. I don't know Friday's dog holdings from anything, okay? Do you think, I don't know American Lithium. I don't know this project in Peru, okay? It's possible. It's not 0% chance. It's possible, like maybe 0.001%, that this is going to be a success. What's most likely to happen is the management of the company sees a hot topic, the shiny object. Let's find some, well, it's not even moose pasture. I don't even know what it would be in Peru. Okay. Monkey pasture in the jungle of a project that somebody had said it was a potential uranium project. Let's get out of the dog shampoo business, change our name, tout this project down there and raise money. The management of the company decided this. They're pleased to announce it. Of course they are, because they can keep their salaries going. They can, go to conferences on first class, stay at, in very nice hotels in downtown near the conference center, go out to dinner, charge everything back to the company, and get another 2 or 3 years of free money to do absolutely nothing. This is what goes on, guys. And this is why I say, if you want to be a speculator, you better really know what you're speculating in, because this is the kind of crap you're going to see as this bull market moves further and gets more and more attention. You're going to see people glomming on. I think we have maybe between 30 and 40 listed uranium companies now. That's going to expand greatly, because why not? Money's pouring into the industry now, or into the market, and starting to get attention again. And we're getting ready. We're in another bull cycle. So this is just the beginning. These guys were smart because they got in at the ground floor here of this, call it third stage of the bull market, what have you, this next move up. You're going to see a lot more of this as it goes on. So this is kind of an education segment, guys. I'm not even going to go look this up. I don't care about it. It's not ever, how many competent uranium exploration development teams are there in the world? That's the question you have to ask yourself. Okay. I don't think that Friday's dog holdings management has that in-house. Okay. I'm not going to pick on them, because in the past, when I've picked on some companies, I've actually gotten letters from attorneys representing companies for saying things like this. But this is obvious. This is a lifestyle company. I wouldn't get anywhere near something like this. And this is what you better go through your holdings and understand what you own. Okay. A lot of the projects that some of these even listed uranium companies have already, they're just recycled projects from Union Carbide and other people from previous uranium cycles that weren't, viable then. They just get repackaged. This isn't even that. That's bad enough where you have a package of recycled projects that has a high cost and a high development cost and isn't viable at, $56 uranium. But this isn't even that. This is buying a subsidiary of another company that's in the lithium business. If the project is so good, why doesn't American Lithium become a uranium development company? There's a lot of questions that are just common sense. So I'm not going to go on about it. I think this is educational, and this is the kind of thing you need to pay attention to. This is why I tell people you should go to one of these mining conferences and walk the conference hall and talk to some of these management teams. You'll walk out of there thinking, oh my goodness, look at all these companies and all this success that everybody's going to have, because everybody has a story. Everybody has a story. This is why mining is a very, very precarious, especially junior development. Okay. Mining's a hard business. It's very difficult to make money in. Okay. It's very, I've went through this before. It's not a very good business except for short windows of opportunity. And it certainly is very difficult for exploration and development companies. Now, there are people in the industry that have success. That's why you go with people that have had success in the past. I've been through this before. I'm not going to go through it again. take a look at this and use it as a warning that you're going to see more of this. So again, some peak ESG news. So they recently, I keep talking about the fact that I think we've reached peak ESG. It will continue on because there's so much money, but I don't think it's going to take over the world like people thought, because it's just not, it doesn't pencil out. The financial portion doesn't pencil out, the physics, the whole thing. Will it continue? Yes, there'll be an impetus, especially in the West. Okay, the Western countries is where this is going to continue. That's why you don't want to be long-term in the Western countries, OECD countries, because if they're going to continue down this path, they're going to get poor. Okay, their standard of living is going to go down. It's going to be harder to make why not move to a country like Georgia? Why not have your investments there? Why not look at Uzbekistan? Look at countries that are doing the exact opposite of what we're doing. Countries that are liberalizing their economies. Countries that are making it easier for their people to build businesses, for have positive demographics, aren't over indebted. That's what you should be looking. Capital goes where it's treated best. Not going to stay here. We're in decline. People are getting old. We have all these problems. We have dysfunction in government and policymakers. You get my point? And this whole ESG thing is a manifestation. It's just another ripoff of the average person that gets ripped off in medical, food, just a complete ripoff all the way down the line. And this is just another example. Again, heads we win, tails we win more. We're not going to change it, but we are going to take advantage of it. A couple snippets from the article. It says about 90% of nations' net zero plans are unlikely to be achieved, according to researchers who say that the shortcomings would result in Earth warming by a catastrophic 2.4 degrees Celsius. If you're still believing these projections many people have listened to all the projections about ice caps going away, all these projections about this, that, and the other. If you still believe that nonsense, then you cannot be helped at this point. I said this before, prophets in the ancient world, if they were wrong, they were stoned. I'm not suggesting we should stone people that make predictions, because I make predictions that are wrong also. But when you're consistently wrong about something as important as this, why do you continue to put confidence in these projections? That's just a little editorial that I had to get in there. So let's go back to the article. The COP26 climate conference 2 years ago in Glasgow saw a flurry of net zero goals set by countries from Saudi Arabia to India. By the end of the conference, more than 90% of the global economy was covered by net zero targets. However, an international team of scientists ranked 90% of countries' net zero plans as having, quote, low confidence of being achieved. The only countries seen as having high confidence of being met were developed ones, including the UK, the EU, and the New Zealand. And those are the countries that you don't want to invest in long term, because they're self-immolating themselves. They are self-destructing themselves with these policies, okay? So there you go. That's my view. Some people agree, some people don't. Would you rather be investing in a country like India or a country like New Zealand or Australia, where they're trying to go down these roads? And I'm not talking about for the next 3 to 6 months. I'm talking about over a decade. Who's going to have more growth? Who's going to have more opportunity? If you're going to hamstrung your country by limiting the amount of low-cost, ubiquitous energy inputs, you are not going to maintain a standard of living. It's just that simple. And people are now seeing that. Okay, that's it for this week, guys. Appreciate the viewership. There's a lot of people that view the channel. If you could help me out with subscribing, liking the channel, comments are helpful. We appreciate the viewership. Again, I don't expect everybody to agree with what I say. I don't agree with what everybody else says, but I think we provide good content here. Again, I think we're getting ready to reach the Wiley Coyote moment. And so I would be, again, it's boring, I know, and I've been repeating it for months now. I wouldn't go hog wild putting capital into these markets. If you're a trader, I guess you can trade. I'm not a trader. I don't trade. I don't try to, trade short term. That hasn't been successful for me in the past. I try to identify the major trends and play them and capture the majority of the moves in those trends. That results in periods of boredom and sitting there with nothing happening. But what typically happens then is that, you know, you'll be sitting there for a year and a half, 2 years, or what have you. Nothing happens. Everybody calls you an idiot. What are you doing? And then all of a sudden, the thesis that you put forward gets traction in the market, and then the market revalues violently upside your thesis. So that's how we do things here. That's not for everybody, I understand, but so far that's been fairly successful for us. Patience is a virtue, and I think that if you are patient here through the end of the year, you're going to be rewarded on the other side with tremendous buying opportunities as the worm turns, if you will. All right, guys, that's it for this week. We'll talk to you next week. Appreciate the viewership and the support. Thank you.